this panel on John's contributions to international economics and to fiscal policy. If I might just say a quick word about John. As Andy Levin said, kindness was one of John's most outstanding attributes. And I've had the good fortune to work with John for nearly 4 decades now. And I agree with Andy's assessment. In all the years, in all the days that I've worked with John, he's been very gentle to me in pointing out my errors of logic and analysis. But I would like to add another characteristic of John, and that is integrity. John is one of the most highest integrity scholars that I know. He never shades his results, never twists his models to achieve a particular outcome. And then in policy-making advice, he never blends politics with economics. He always has been a straight shooter on giving economic policy advice. Give the economics, let the policymaker decide on the politics. That's the way good economists give economic advice, and that's been one of John's hallmarks. So John, it's been great for more than 30 years working with you, and I'm looking forward to more. So our panel, we've decided to break the panel into 2 parts, one on international finance. We have Barry Eichengreen and Bob Hodrick. Then we'll have fiscal policy with Valerie Ramey and Mike Boskin. So Barry, you want to take it away?
So it's a pleasure and an honor to be here. The distance between Berkeley and Stanford is great. I'm referring to the mileage and the traffic, of course, although it can be interpreted otherwise, I suppose. John and his wife have been very gracious over the years in terms of inviting us, my wife and I, into their home when there are visitors from Europe, for example, who discovered that the distance between Berkeley and Stanford is great. So we're very appreciative of that. Before the other John rearranged the panel a little bit, I thought of myself as providing a bridge between this session and the next one. And I still think of myself as doing that, just a little bit out of the intended order. So my talk on international cooperation and John Taylor will focus on 2 things. Collective action clauses, which Michael Bordeaux mentioned earlier today, which are provisions in loan contracts, typically sovereign loan contracts, that enable those debts to be restructured in a more orderly, expeditious way. And EAP refers to the IMF's exceptional access policy. Under what conditions, under what circumstances are IMF member governments able to borrow more for longer periods under exceptional conditions? John played an important role in the promulgation of both of those new arrangements. So he tells the story of both, actually, in his book, Global Financial Warriors, focusing on the year 2002, but on surrounding events as well. So I was looking at this slide on my phone earlier and regretting the existence of autocorrect. This is a self-serving remark rather than a self-servicing remark, but both make the point. I like to claim that I'm one of the first 2 authors, along with Richard Portis, who made the case for collective action clauses back in 1995. Why 1995? Because this was in the immediate aftermath of the Mexican financial crisis. The Mexican financial crisis occasioned an unprecedentedly large IMF program, and it fanned worries about moral hazard for reckless policymakers in emerging markets who might have reason to anticipate that they would get larger, more generous IMF bailouts if they got into trouble, and reckless creditors as well. insofar as they were able to exit whole despite the crisis with the help of IMF finance. They might be inclined to lend less discriminately in the future. So the solution to this problem was to make it easier to restructure problem debts as alternative to large-scale rescue packages, bailouts, and that in turn would make it possible to limit those exceptionally large programs because there would exist an alternative, namely those easier restructurings. Undersecretary Taylor had to overcome multiple obstacles in making the case for collective action clauses and an exceptional access policy. There was the fear of higher borrowing costs, which limited the willingness of emerging markets to issue bonds with these questionable provisions. There was the fear that they would have to pay a novelty premium if they went first, so nobody wanted to go first and send a negative signal about their own potential creditworthiness. And there was an alternative IMF proposal and Kruger's sovereign debt restructuring mechanism. So I write here that John had to overcome the irresistible temptation for the press to set these up as competing proposals and characterize the two Stanford professors and golfing partners as rivals rather than collaborators seeking to achieve the same thing in different ways. Collective action clauses became the norm in sovereign bonds issued under State of New York law as a result of this series of steps that spanned early 2002 through early 2003. John wrote a pithy one-page memo to Treasury Secretary Paul O'Neill making the case for these provisions. He delivered a speech at the IMF spring meetings announcing the Treasury's action plan for making this idea happen. Treasury led the international effort to develop model clauses that might be adopted by bond underwriters and governments going forward. At the fall 2002 IMF meetings, Treasury brought all the stakeholders, both private and public, together in the Treasury cash room, but there was no agreement on immediate action. Finally, in early 2003, the government of Mexico agreed to go first, and that kind of broke the logjam with many other governments then following, to the point where these clauses are now indeed the norm in the United States under New York law, as they had been previously under English governing law. They'd been around for a long time outside the United States. That's where the idea came from. So I looked with co-authors at the impact on borrowing costs because we had this comparison of bonds that issued in London that contained collective action clauses, bonds previously issued in New York that did not include them. And Ashok Modi and I found that for good credits, the borrowing costs actually went down. Nobody thought that a good credit would opportunistically restructure its debts, but if a bad thing happened, it would be able to do so in a more orderly way that would benefit the creditors as well as the borrower. If you were a bad credit, there were worries about opportunistic behavior if restructuring became easier and their borrowing costs went up. And we concluded this was a desirable outcome because it encouraged, it rewarded the good, it penalized the bad, it allowed lenders to differentiate more clearly between credits of different quality. We looked in a related paper at the next set of innovations, which were aggregation clauses, where the holders of different bonds, different bond issues, their votes, their investments were aggregated when a qualified majority was required to agree on a restructuring. And we found basically the same thing, that these provisions benefited the good creditors, they penalized the good credits, they penalized the bad ones. The IMF revisited this issue more recently, and it looks like the more recent evidence now that there has been more experience in New York with these bonds is that enhanced clauses lower borrowing costs across the board. Finally, a couple of words about exceptional access policy. This was another policy innovation pushed by Treasury in the period when John was in Washington. He writes in his book about how he preferred rules over discretion, influenced by you-know-who, Kydland and Prescott, and John's own work on monetary policy rules. So the exceptional access policy didn't turn out to be a hard and fast rule. It turned out to be more constrained discretion, if you will, and I was struck this afternoon in discussions of the Taylor rule, how neither is that a hard and fast rule, but it's a form of constrained discretion where deviations from the rule have to be elaborately justified. I think you can say the same thing about the IMF's exceptional access policy. So it turns out that the fund's independent evaluation office looked at the exceptional access policy very recently, last year, and they concluded that the policy did succeed in encouraging, quote, deliberate and systematic consideration of large programs, but at the same time, it worried that lack of clear numerical or other benchmarks raised questions about even-handedness, whether all countries were being treated in the same way. It pointed to repeated ad hoc changes in the framework as special cases arise, the systemic exemption, for example, for large, systemically important countries whose problems, if untreated, might destabilize the global system. And it suggested that staff may have reverse engineered on occasion whether cases qualify for exceptional access in order to allow a large program to go forward, which in instances where that was staff's preference. So there still appears to be no support in the institution, according to this report, for a binding rule. I think there are questions about whether the discretion is yet sufficiently constrained. So exceptional access policy is a work in progress. I was looking the other day at the size of IMF programs, IMF arrangements. There is some sign of them becoming smaller relative to GDP after the adoption of the policy. I don't know whether that's the direct effect of the policy or changes in the mix of countries that are on the receiving end of IMF arrangements. So, and of course, there are always also cases like this which I think are not very encouraging when one thinks about a systematic process for encouraging exceptional access to IMF resources. So my conclusion is that John's work on the international financial architecture during his days in Washington, D.C. Resulted in very considerable, significant achievements. Thank you.
I would like to begin by thanking the organizers, John Cochran and Michael Bordeaux, for inviting me to share in this honor of honoring John. It's been a pleasure to have him as a colleague for the last 10 years. So today I'm going to talk about what I think of as his fundamental contributions to international economics. So given the constraints on time, I'm going to focus on the book that he wrote, so it's going to be a quick book review. So, Macroeconomic Policy in a World Economy, from Econometric Design to Practical Operation. There's going to be 5 steps in this. So I'm going to take you through each one. It's really a treatise on how to do normative economics. And by that I mean the search for systematic policies and rules that monetary and fiscal authorities in open economies, which everybody is in an open economy, can follow. And so I'm going to start by reviewing the model. The first requirement is you have to have a state-of-the-art model. So nobody put up the overlapping contract framework yet, so I thought I'd skip through that, but there it is, equation 1. The X is the contract wage. How is that set? It's set on the basis of expectations of what future market wages are going to be. That's the W. And what future prices are going to be. That's the P. And what future income is going to be. That's the Y. And the actual wage, what's going on in markets currently is just a weighted average of past contract wages that have been set in the past. Now, the price level in an open economy is going to depend upon the wage rate in the economy as firms mark up over their costs, but also on the prices of foreign goods. So we ought to bring in the exchange rate. E is the domestic currency price of foreign currency, and P star is the foreign currency price. Aggregate demand is going to be met by firms who set these prices in advance, or actually simultaneously as they're setting wages. And that depends upon the real exchange rate, negatively on the real exchange rate, or negatively on the real interest rate, excuse me, positively on the real exchange rate. So that's the relative price of foreign goods. If that's high, we buy more domestic goods. And then on what's happening in foreign countries' output as well. The real interest rate has the same definition that we normally see as the nominal interest rate minus expected inflation. We get money market equilibrium condition. So the real balances depend negatively on the nominal interest rate and positively on real income. And then an international capital market equilibrium condition that's uncovered interest rate parity. The interest rate in the home country is equal to the interest rate in the foreign country, adjusted for the depreciation that's going to take place between the domestic and foreign currencies. So that's seven equations. There's to close the model, we add a money supply function or an interest rate rule for each country, and similar equations for each country. So there's only 6 for the foreign country because we have an international capital market equilibrium condition that's the same for both. So how does the model work? Well, the first thing he does is John sets about this by saying, what are some plausible parameter values? I'm going to put those in and then simulate the model and see what happens. So I'm going to focus just on what happens if the domestic money supply is increased. That's going to increase real balances in both countries. So the nominal amount of money goes up in the domestic country, the prices are relatively fixed, so real balances go up. In the foreign country, price level goes down because the domestic currency depreciates, the foreign currency appreciates, and so the price level falls in the foreign country. So they get a boost in their real balances. Domestic interest rates and foreign interest rates both decrease, but the domestic interest rate has to increase more, and this is to clear the money market in each country. And expected inflation starts because now prices are low. They're only temporarily low in the foreign country, and they're starting to increase in the domestic country, and they're going to increase over time. So both of those effects lower the real interest rate in each of the countries. There's a positive output shock that takes place. And over time, that's going to go away. Over time, prices are going to rise in the domestic country and fall and rise a little bit in the foreign country to get back to equilibrium. Domestic currency depreciates. And one of the primary results in international economics, one of the most famous results, is Rudy Dornbusch's finding that the exchange rate often overshoots its long-run equilibrium. So why does that happen in the Dornbusch model? Well, prices are fixed, output's fixed. The only thing that can adjust is the nominal interest rate. It goes up, and because of expected inflation, but that means that the it actually falls, excuse me, it falls to clear the money market, and it's now lower than the foreign interest rate. So the domestic currency has to be expected to appreciate. And that was a result in 1976, and we're going to see where the first empirical evidence of that takes place later on. Okay, so given that you have this model now, you've got a model. How are you supposed to address the data? Well, John says you should use full information maximum likelihood. That's what Ohanian said earlier. That there's no like skipping around here with if you have a simple enough model, you use full information maximum likelihood. If you don't, use some other state-of-the-art technique. Hansen's generalized method of moments. So for larger models. Now, when he actually gets around to thinking about, well, I don't just want to work with the two-country model, 15 equations. There's many more countries in the world, and I'm going to look at interactions between all of these countries. So he systematically sets, and this is the heart of the book, sets about, with a more complicated model. 7 countries, Canada, Germany, France, Italy, Japan, UK, US. Price and wages are the same kind of equations in each of the countries. Consumption demand is now separate equations for services, non-durables and durables. There are investment equations for residential and non-residential investments, inventory investment. Demand depends now on the real interest rate on the long-term bond. So he introduces a long-term bond as well as a short-term bond. And permanent income. So now we're getting closer to more modern models. This is work that was done primarily in the 1980s, in the mid-1980s, and then John paused to take positions in government, and the book came out in 1993. So we get permanent income and long-term real interest rate. There's exports and imports now in these countries. Exports depend upon the terms of trade, and then a weighted average of the GDPs of the different countries. And imports, similarly depend on the terms of trade and domestic GDP. And now this was a really interesting feature for me. John knew that finance research had shown the significance of time-varying risk premiums. He didn't want to, put in, go all wild on, I need a complete maximizing model. He put in shocks to the interest rate parity equation and shocks to the relationship between long-term bonds and expected future short rates. So that was the third step, or the second step. Now the third step is so he's estimated the model, got a state-of-the-art theory, estimated state-of-the-art techniques. Now we have to get the structural shocks of the model. So this is where he relies on the work that he did with Ray Fair, and it requires dynamically simulating the model into the future, conditional on the data at each point in time. This is the extended path method, and John describes this in the book as straightforward but computer intensive, and I think that is an understatement. That does not do disservice to the quality of computer programming that went into that analysis. So there's 136 impulse response functions, because you have to get the real shocks that are in the model. And I'm going to present 2 of them. So this is a shock to the model that is a 3% increase in the US money supply. So what happens? So the dotted line is the price level. The price level slowly increases over time, eventually asymptotes out at 3%. It takes 2.5 years, or no, 4 years, excuse me, it takes 4 years for prices to increase by 2.5%. So inflation is sticky during this whole time. Output responds relatively quickly. After 3 quarters, it's 1.8% above trend. This is an incredible temptation to the monetary authority, if it sees a negative shock, to try and step in. Oh, I'll just put a little bit more money in the economy, and and we'll, all the people that are unemployed will go back to work, and inflation is delayed. And this is true in each of the economies that in the estimation. The other interesting finding from my perspective was what happens to the exchange rate. So, and the nominal interest rate. So the dotted line is the nominal interest rate. You increase the money supply, interest rates have to fall to clear the money market. The exchange rate of the dollar goes up. It goes up above 3%. This is the first evidence of Dornbush overshooting, first empirical evidence of Dornbush overshooting that I know about. I actually asked ChatGPT who was the first, and they said it was Eichengreen and Cristiano, and that was 1996. So this is way before that. And I'm wrapping up. Okay, I got 2 more steps. The fourth step is alternative policy rules with stochastic simulations. So you now have this model, and you can ask questions of the model with simulations. Which is better, fixed exchange rates or flexible exchange rates? Allowing individual countries to respond to their individual economies ends up being much preferred in terms of the variances of output and inflation. Is there a necessity to coordinate policy across countries? No. It turns out that the non-cooperative equilibrium, the Nash equilibrium, is just as good in the simulations as a coordinated equilibrium. And then what is the best feedback rule? Well, we see the Taylor rule there. Okay, so that's the 4 steps in the book. I'm adding a 5th step. This is how Taylor proposes to give policy advice. Develop a state-of-the-art theory, estimate it with state-of-the-art econometrics, find the structural shocks and their distribution, which allows you to do simulations, simulate the model to find the best rule, and then once you have that rule, go to the government, get involved in policy, and make the world a better place. And I think that's what John did. Thank you.
It's a great pleasure to be here to help celebrate John Taylor's accomplishments. Before I start talking about Fiscal, I just wanted to say 2 quick things. So first of all, I was a graduate student here at Stanford when John arrived, and he completed the macro sequence so well. Unfortunately, I'd already taken all my courses by the time he arrived, but he was so patient. He was a member of my dissertation committee, and I was trying to do inventory investment. As you know, you need dynamics, you need rational expectations. And so I would go into his office, and he helped me fill in those gaps that I had in my training. So I really appreciate that. And you were, again, kindness and patience as well. Second thing is, I was at the Carnegie Rochester conference where his Taylor Rule paper was given. All right, so I was an assistant professor. This was, spring 1993. I was presenting a paper. Ben Bernanke was my discussant. Now, John Taylor's paper didn't arrive in time for when they sent out the packet. I always read all the papers when they sent us the packet, but I couldn't read that one. And it was sent at the very last minute. I remember it was on the table. And then when he presented, he was just so low-key and humble and said, well, here's this kind of rule thing. Well, he was perhaps too humble, because when you look at the table of contents, so Charlie Plosser and Alan Meltzer were very nice to put a young assistant professor, me, at the top, but they put John Taylor's paper way low, so they had no idea what kind of blockbuster they had. So fortunately, posterity figured it out, and we're all the better for it. So John Taylor's, of course, well known for monetary, but he also has considerable contributions to fiscal policy. He has numerous books, articles, op-ed pieces, congressional testimony, and of course, service in government. What I'm going to do is just focus on 3 since I have a short amount of time. So which 3 would I focus on? I'm going to talk a little bit more, just briefly, about that wonderful book from 1993 that Bob talked about, and that this is why we changed order, so that you could know all the details of the equations and I could add just a little bit. So it was one of the first policy analyses that rigorously incorporated the rational expectations revolution and worried about the Lucas critique. The second I'll talk about is his analysis of automatic stabilizers, which of course policy rules in the fiscal domain versus discretionary fiscal policy. Some of that is in his 2000 Journal of Economic Perspectives paper and some of his follow-up papers. And then the third is I'll talk about his amazing real-time analysis of some of the discretionary fiscal stimuluses that have occurred during crises. So first, as I said, it's one of the first large-scale international macro models that incorporated rational expectations. It analyzed both fiscal and monetary policy. Bob talked about the monetary, but the fiscal policy was really impressive because he was able to run experiments not only about what happens if there's an unanticipated increase in government spending, but also if there's anticipations of a future increase in government spending. He could talk about temporary increases, he could talk about permanent increases. Before the apparatus that he set up, it was very difficult to do that. And when I was writing my QJE paper that talked about news about future government spending, he contacted me and said, oh, I wrote about this a little bit in 1993. And so I was really able to build on what he had done. And then also the serious modeling of the policy spillover. So that's really a tremendous book that he had there. And one of the contributions was through fiscal policy. So then the second thing is his piece on reassessing discretionary fiscal policy, where he talks about the benefits of automatic stabilizers versus discretionary fiscal policy. And it's just a wonderful piece. I think I'd read it long ago, and I reread it preparing for this, and it's just wonderful. It lays out the issues just very clearly about implementation lags with discretionary irreversibility and political constraints. He also argues something I hadn't thought about, which is that the conduct of first of all, the conduct of monetary policy had already improved substantially so that it could really do most of the stabilization of the economy. But not only that, that having automatic stabilizers in fiscal policy was much better than the discretionary because it made the conduct of monetary policy easier because they were facing less uncertainty. And rereading this made such an impact. This morning I was emailing back and forth with Olivier Blanchard, and we were talking about, yes, there should be more automatic stabilizers, although I'm always skeptical because since politicians always want to show that they're doing something about the crisis, they're always going to be tempted to do discretionary. So if automatic stabilizers are too generous and then you put discretionary ones on top, then you end up with more debt. But still, at least in theory, it's a great idea. And then he also considers the problem of the zero lower bound. This is in 2000, where a lot of the rest of us thought that was just some Japanese thing, that people had to worry about. And so he was thinking about these questions way in advance of when we needed answers for the US. The second is the effect, these real-time analyses of the various discretionary policies. So the effects of the Bush 2001 and 2008 tax rebates, the effects of the ARRA, and then also all of the COVID stimulus packages. So the Bush 2008 tax rebates came out in the summer of 2008. By November of that year, John had a Wall Street Journal article with a graph that said the rebates failed to jumpstart consumption. And he showed this very telling graph that shows disposable income shooting up and not much happening to consumption. So he also showed, doing some simple aggregate regressions, that the coefficient on the rebates was basically 0. Now his point continues to hold, even if you look at the revised data and extend it through the present. There's just not much going on with consumption. However, people ignored his analysis because subsequent household level analyses found these huge MPCs, marginal propensity to consume, out of the rebates, and the credibility revolution had taken over, and so applied micro was believed, and nobody believed the macroeconomists. Well, my co-authors and I have spent the last several years proving that John Taylor was right. So you can read all of those papers. Some of them are forthcoming in the QJE. The multipliers on the rebates, we calculate, were below 0.2. So he was absolutely right. Then for the ARRA, with John Cogan, Quick, and Leland, John Taylor did this wonderful paper on new Keynesian versus old Keynesian government spending multipliers. What's really neat is that the first draft was circulated in February 2009. So this is real-time analysis, right when people needed to see this. So they questioned the Romer-Bernstein old Keynesian model predictions of the effects of the ARRA, and everybody remembers those, with the ARRA without graphs. They compared it to the then new Smets and Wouters medium-scale new Keynesian model that was related to the Cristiano, Eichenbaum, and Evans model. And you probably cannot see that. Well, maybe you can. They got, although on impact, they got multipliers around 1, both the old Keynesian and the new Keynesian, but then it dies out pretty quickly in the new Keynesian models, whereas the Bernstein and Romer and Bernstein had the multipliers actually increasing. Now, this was for a permanent increase in government spending. They were able to, in their model, go on and do something much more realistic, which is to take the actual predicted path of government spending, and there they found multipliers of around 0.5. They were even able to add the effective rule of thumb consumers. It's just amazing that they were able to get all of this done right then when the policy debate was going on. Now, 2 of my empirical papers in 2019 questioned some of the high multipliers people were finding in cross-state analysis, and I suggested that they weren't 2, that it was something like 0.7. So again, I had some work proving once again, John Taylor was right. He also talked about the economic impact of the economic impact payments, which was the COVID stimulus. He did the same kind of straightforward analysis and didn't find evidence that it stimulated consumption. Maybe I will start working on this. I haven't yet. Stay tuned, but don't be surprised if maybe John Taylor was right about that one. So, John Taylor's contributions to the analysis of Fiscal, he pushed the frontiers of economic science in terms of the modeling. He was prescient in the questions asked. So as I said, with the 0 lower bound, how far in advance he asked that. And then the timely analysis of the most important fiscal policies of that time period, he was there front and center doing that. So thank you for all your contributions and also for being such a wonderful mentor.
As you can see, the order of our session was reversed. So originally I was going to tee up some of the others, and now I suppose I'm batting cleanup. Not that there's anything to clean up about what was said, but let me first start with an elaboration of a theme throughout, and that's about the great person John is, as well as great economist and great friend and colleague. The word kindness has come up repeatedly, and toughness has come up too. John has very strong views, and he, as John Cogan said, he doesn't tailor, no pun intended, tailor them to who he's talking to, as some people do, et cetera. But I would say of the hundreds of conversations and meetings I've been in with John, I've seen him have been tough many, many times, but I never once ever saw him be mean. And that's really an important distinction and speaks well of him as a human being. So that's part one. Also, there's another session on John and government, but it's mostly going to focus, I think, on John's time in the Bush 43 administration, given the framework. I obviously worked with him on the council in Bush 41, so I'm going to say a few words about that. But let me just say, it was quite an interesting time. We had the collapse of the fall of the Berlin Wall, the collapse of the Soviet Union. We had a tremendous oil shock. Saddam Hussein invaded Kuwait. Oil prices doubled at a time when we had large oil import intensity in the economy, and we had a recession. So, and at a time where the president's party had 164 congressmen and 43 senators. So it wasn't exactly like he could wake up in the morning and decide what he wanted to do, sort of as the current president tries to do. Okay, so it's different times. It's also important to point out something that really I think hasn't been stressed enough. People have said how well John's work has held up, but it's useful to point out how much has changed in the economy over this period, and the global economy, demography, technology, et cetera. So if you go back to those great late 1970s papers, there was no personal computer. Deng Xiaoping hadn't opened up China yet, and China wasn't on anybody's radar screen for many years later. The vast majority of credit extended was extended by traditional financial institutions, not by the credit market directly, which is totally reversed now, where maybe 3/4 of it is extended by the credit market directly, and only 25–30% by banks and other financial institutions. So I could go on in this regard, but a lot's changed. I also want to emphasize, while Valerie added Fiscal to John's tremendous contributions to economic policy, and I'll say a word or two about that in a moment, John's contributions extend well beyond just monetary and fiscal policy. One of the great things about the CEA is you get to work on everything. And John played a tremendous role across a wide variety of things. And I must say, one thing that hasn't got much attention is he helped us improve our response to the previous financial crisis, which, because was superseded by the Great Recession and financial crisis, doesn't get much attention. But in fact, back then, we had the savings and loan crisis and the third world money center bank debt crises. It's not often remembered that virtually every money center bank, and this was before they all merged, there was a separate Manny Hanny and Hanover's Trust and all this other stuff. Chase and JP Morgan hadn't merged, et cetera. That they're all mark-to-market insolvent. And why? Maybe Sebastian will talk about this later on. But Miguel de la Madrid, the president of Mexico, he repudiated his debt, and you had all this Latin American debt that the banks had been involved in, egged on, encouraged by our State Department and our Treasury to help Latin America. And they wound up in very, very difficult circumstances. If you could trade that debt, if you could trade it, it was selling at around 15, the bid-ask spreads were enormous, but it was trading at maybe 15 or 20 cents on the dollar. So that had to be worked out, and hence there was a lot of issue. We wound up with Brady bonds, et cetera. But John played a role there, and I think that deserves some mention. But let me just mention a few things kind of adding to what's been said, including this issue. So let me see if this will work. Okay. So again, just brief perspective. I'm going to say a word about the evolution of his thought on monetary policy and rules more broadly across many types of policies in a moment. So first, of course, great attention has appropriately been focused today on his pioneering work in macroeconomic modeling, and I'm not going to repeat that, just to say that it set the stage for thinking more deeply about monetary policy and what it should be, and therefore its interaction with fiscal policy. It's probably worth adding, for all the people who were talking about Fidland and Prescott and Lucas, that I'm old enough to remember a previous debate and discussion about fiscalists versus monetarists. The early rules versus discretion went back to Friedman and Tobin and Samuelson and Solow, and a variety of people of that sort, worked out in academic papers, and especially in op-eds and Newsweek and so on, and policy advice. And it was very clear that fiscal policy especially had involved numerous temporary episodes, and that seemed not to have done a whole bunch to stabilize the economy, given the frequency of recessions we had from in the 1950s, 60s through the early 70s. So that's part one. I want to reemphasize what Valerie said about John's and John Cogan's with Volcker's real-time estimates of policy. That's not an easy thing to do. In some sense, you have to be conjectural. But it became pretty clear that while much has changed in what the government does, its desire of politicians to hand out money to people when they have an excuse or a putative need, and to call it stimulus, even if it has not much chance of stimulating a whole bunch, didn't die out, unfortunately. So we have these series of episodes that Valerie mentioned and John doing real-time analysis. But here we were in the summer of 1990, and the economy was growing but slowly, and we had a lot of tensions in credit markets with the Basel Accords and all this sort of stuff. And then Saddam Hussein invaded Kuwait, and we had the big oil shock. And we didn't get data on the economy shrinking at all till, I think, February of 1991, but it became very clear to us that the economy would likely go into recession. And we had been in the middle of negotiating, trying to do something about the budget deficit with a very weak hand, as I described, that President Bush had. Not making excuses, I think it's just a fact. And the Democrats wanted to increase spending a lot, and John and I were very dubious it would do very much, and that it would, on a benefit-cost basis, have benefits at all commensurate with the costs that might be incurred and the future problems. And President Bush listened to that pretty carefully, and I think kept his desired interventions to a minimum. We did a few things around the edges. We said there are opportunities. If you need to do this, there's least worse ways to do it. But he stuck to doing minimal stuff. Some people think that that was a political mistake. He always thought that it was Ross Perot and his breaking the new taxes pledge that did him under. But in any event, let me just turn back to John on rules beyond monetary and fiscal rules, and I'll say a few words about fiscal rules in a moment. We were trying to negotiate NAFTA, which we at CA kind of helped originate along with the Secretary of State, and the move to the World Trade Organization. And John got to play an important role in that, assisting our trade representative. And if there's a place where rules matter, even though they're honored frequently sub rosa in the breach as well as the observance, it's in trade policy. And we're going through that now because despite the best intentions, the Trump administration is not going to come down from the mountain with some tablets saying, here we are. These are very complex, detailed documents that have to be approved by legislatures in many countries. So he played a key role in, I think, keeping some of the worst stuff out and promoting some good aspects of that. And it's then, again, from his deep conviction that setting rules and a framework is really important. Okay, we had many discussions about monetary policy during this time, as you can imagine. There was a need to further disinflate the economy, but the economy was softening, so it put the Fed in a bit of a pickle, and it put us in a bit of a pickle. And we had various discussions with the Fed board, and especially the chair. And then we decided to write, Bob King graciously mentioned this earlier, an economic report of the president about the desirability of monetary policy rules. As you can imagine, this was not the, for those who aren't aware of what happens when you write the economic report of the president, you send chapters around to any relevant agency that might be mentioned or involved so they can try to argue against what you're saying or improve it or give you additional data or say, do you consider this? And the Fed was not exactly thrilled with this discussion and this mention. But after many different formulations, I think it's come out in the discussion now what he really meant, which is more important than what we really meant. Was we came up with the formulation that monetary policy should be rules-based, by which we meant it should be anchored, framed in a rule. You should deviate from it only for good reason, and frequently, as Bob Barrow mentioned, Robert Barrow, and that should be well explained. I think people have emphasized that. So John has always been very proud, as have I, that this is the first time anything like that had ever been written in an official US government document. So thank you for that, John. I think it had some influence and he went on to bigger and better things. But now getting back to fiscal rules, John, as Valerie mentioned, carefully tried to analyze separately or disentangle automatic stabilizers from discretionary spending, discretionary policies, with trying to disentangle that, and the data isn't always the easiest thing to do. Not mentioned often enough is how important it is to disaggregate the type of spending. Particularly, one of the big changes in the world is that the governments around the world are no longer primarily purchasers of goods and services as they were in the 60s and early 70s, but they're primarily redistributors of income with social insurance and transfer payments. And the proclivity now is for, even though it's all this discussion of infrastructure in the AARA, it was like 7% of the total. And it turns out that, as President Obama finally admitted, the shovels weren't exactly ready, and you don't take a disemployed carpenter and make them into a tower crane operator overnight. So this was a big issue. So he did a great job of that. But in addition to, and so he disentangled transfers, and John and Volker disentangled the payments to state and local governments and tried to trace through where those went, et cetera. So I think it really is a very thoughtful and deep and important contribution, and sets a floor for everybody else's work to do likewise. Then getting back to fiscal rules, first of all, Valerie, you're macroeconomists and microeconomists, I know, don't always agree on everything, but let me say that one of the easiest ways to increase the automatic stabilizers would be to have much deeper progressive taxation and much larger unemployment insurance benefits. I personally think the incentive effects of that would dominate any potential modest automatic stabilization. And indeed, one of the things, I guess, is partly what I was doing around the same time John was doing his work. One of the things I think that has started to get incorporated in macroeconomics, including Robert Barrow and Redlich have done this in aggregate data, is to try to look at incentives and effective tax rates and how they work. I'll talk about this more tomorrow in my talk at the late in the monetary policy conference, but I do believe that tax rates and effective expectations of tax rates in the future play a role both in the long run and in the effectiveness of short-run stabilization policy or stimulus. But in any event, there have been many attempts to try to come up with new fiscal rules. Presidents have tried to have enhanced rescission and line item vetoes. They were stopped by the courts. Back when we thought we had very large budget deficits in the Reagan administration, cyclically adjusted, they were pretty small, but in any event, they were deemed too large, and we had lots of discussions. And so Graham-Rudman-Hollings was adopted, which was basically a requirement to project you would gradually reduce the deficit to zero over a span of years. Okay, almost done, okay? And then finally, what happened was the projections were optimistic, and we didn't get there, and they were extended. The same thing wound up happening with the Maastricht rules, where they became inconvenient. But anyway, out of this came one of the things that I think perhaps was reasonable, people will disagree, that was the pay-go rule, which was basically a marginal balanced budget rule. We couldn't deal with the inherited debt, and we couldn't deal with a variety of other things, but I'll leave it to you to decide. Even though it was kept for quite some time, then it was off, then it was put back on again, so it's had some at least modest restraining benefit on the elected officials. But it turned out that Democrats hated it because it constrained their ability to increase spending, and Republicans hated it because it constrained their ability to cut taxes. So in any event, we'll see where all that winds up, but we've had, commissions, and we may have another commission, but we're dealing now in uncharted waters where we have very large debt, very large deficits adjusted for the cycle, and we have too often descended into an anodyne discussion just describing the situation as unsustainable. So I'll talk more about that tomorrow, but John, you've been a great giant in the profession. You've been a wonderful friend and colleague to me, and I look forward to many more years of that. Thank you.
So we got a couple of minutes for questions or comments from anybody.
I want to say something about the intersection of kindness and students. In the spring of 1990, I was, when John was a member of the council, I was in DC, and I tried calling his office to see if I could see him sometime. And his secretary was, let's say, not particularly friendly or encouraging. And then she said, well, like, basically, who are you again? And I happened to mention I was an ex-student. And she goes, oh, John always wants to go to lunch with ex-students. When would you like to come? and so it's just, yet another testament to his character.
John.
Thanks a lot. I just want to, one of your panelists said another instance of John's making the world a better place. I wanted to give you a pragmatic that I know something about anyway, and that in his tour as Undersecretary of Treasury for International Affairs, he basically worked with Iraqi officials to establish the central bank. John was back in Stanford when the Iraqi Civil War was still had a few years to go, and but the reforms moved slowly, but now are accelerating, and the fundamental change in the Iraqi financial system remained intact. The last 5 years, the bank accounts of Iraqis have gone from 2 million to approximately 20 million. The Baghdad skyline's full of cranes with construction boom. With Turkey, Iraq is building an alternative trade route to Europe, bypassing the Suez Canal. There's been in the Iraqi central bank one devaluation since the inception, I believe, in the inception of 2002. The dinar, the currency of Iraq, is in a little over 20 years has appreciated to the dollar by approximately 40%. This is an instance where pragmatic application of economic theory has helped lead to a meaningful increase in the lives of 42 million Iraqis with the median age of 22.
Well, thank you, John. Well, thank you, panelists, for the time and effort you took to make these presentations. And now we have a break. Thank you all.